You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Are you ready? I have 10 minutes covering 20 stocks offering a 4% yield. Those are my favorite ones that are very relatively solid and growing their dividends. That's the most important thing. So here we go. Take your note, park your car because it's gonna roll very fast. First one on the list, Enterent. iip.un.to. What I like about Entrance, well, the yield is at 4.03%. So the first one making the list. After that, we're going up. I love apartment REITs. They're stable. They are able to increase their rate every year. And the one thing that I like also is, while we keep talking about it's really hard to buy a house in Canada, well, there you go. You have apartment REITs that comes to the rescue, and it's actually doing pretty well. So it's a rare REIT that I like. Decent dividend increase. Of course, you're not going to get 5 to 10% distribution increases there, but a solid choice. Number 19, Acon Group. ARE.TO. So big warning on this one. Yields at 4.07. It's a small cap in the construction business. It is highly volatile. So not for the faint of heart. If you're building your retirement portfolio and you don't want to have any stress, probably not a good one for you. But Acon, has been go through ups and downs. The problem is they have large industrial contracts, and with inflation and labor shortage, they kind of went under. Now the situation is a bit under control, so might want to take a look at it. Number 18 and 17 are actually two life insurance companies. So we have Manlife at 4.19 and Sun Life at 4.25. Don't buy all life insurance in Canada, but the three of them, and Great West is coming up not too far, pretty solid as well. Those companies, they are well diversified between offering life insurance products, between doing it either in Europe for Great West, in Asia for Manlife, and then a big part of it is also wealth management for the three of those, so between 20 and 30% of their revenue. So very interesting here. Nutrien, 4.31%. Again, another one that comes with a heavy warning. Keep in mind, Nutrien is the results between Agrium and Potash merger a while ago, and Potash actually did cut their dividend before doing the merger. So there is a possibility there that at one point we have a dividend cut. Right now, Nutrien is a classic play on commodities. So as long as fertilizer prices are low, the company is not making a lot of profit, so the dividend is not going to increase that much, and the stock price will be following a roller coaster. So again, probably not the right type of investment if you're not looking to ride a roller coaster. So keep that in mind. After that, we have Great West Life and Power Corporation, both end in ends because they have a similar yield. So 4.44 for Power, 4.5% for Great West, and actually Great West is partially owned by Power Corporation. So there you go. So on the one side, you have a life insurance company, and then Power Corporation is a kind of almost the Berkshire Hathaway in Canada, maybe more focused on the financial industry though, with IGM, with Wealthsimple, and Great West Life. So we're more about life insurance investment, but still good diversification. Definitely the pure definition of a deluxe bond. Now moving up, we have Canadian Tire at 4.92. Again, this one, in terms of retailer, honestly, I do prefer the low yield, high growth stocks such as Costco and Dollarama. But if you're looking for yield, it's almost offering a 5%. They recently sold Ellie Ensign for $1.3 billion, trying to restructure the company to face tariffs. It's going to be an interesting moment for them, but definitely a good yield that has been increased for a while. Then we come with some magical banks. We do have a lot of banks offering a 4% yield. We have TD at 4.96. We have CIBC at 4.78. And we have BMO at 4.5%. So three great banks. BMO more geared towards capital markets and investment. CIBC more of a classic play. And then TD is going to struggle a little bit more. Probably going to be on the penalty box a little bit longer for the money laundering problems they had in the U.S. So they're capped to grow their banking assets over there. So now they're doing asset recycling. They're selling their assets, such as Charles Schwab's stake, to find other growth opportunities. We'll see how it goes. But anyways, you cannot really go wrong on a bank. So those are like three generous one. Granite. 4.98%, grt.un.to. Very frustrating holding in my portfolio because the numbers are there, but the stock is not going up. Like the market just doesn't give it any love whatsoever. So you have been warned. I have it in my portfolio. I'm not super happy about it, but as long as the numbers are great, I'm going to keep it. TC Energy, TRP, 5.22 natural gas pipeline. Enough said, you know it. The next one, Exchange Income, IEF at 4.24%. Small cap, grows by acquisition. Half of the business is actually manufacturing industrial pieces, and the other half is around the aerospace segment and aviation. So strange company in terms of diversification. The manufacturing are not necessarily making aerospace parts on top of that, but decent dividend grower, has gone through the pandemic without cutting it. So definitely an interesting play. Algoma, ALC, 5.4%. Another small cap. Be careful with those. Again, Algoma is doing maritime transports. Doing not that bad. I mean, the dividend triangle is not super strong, but I mean, it's growing, and at 5.4%, maybe worth a little look. Keep in mind, again, small cap, very dangerous for roller coaster ride. Then we have Capital Power, CPX at 5.5%. An interesting play. They are doing a lot of like diversification towards natural gas. They are mainly based in Alberta, but they're diversifying, so I kind of like that. Big play also on the power needed for technology companies related to cloud and AI. Expect a lot of volatility on this one, but never missed a payment. Still so far, so pretty solid. Canadian Natural Resources, CNQ, 5.88%. This one, I mean, never going to let you down. Almost 30 years of dividend increases, going through all kind of oil and gas cycle. You can trust it. They based on like very high quality asset, but do not expect the stock price to skyrocket as it did in 2020, 2021, 2022. Those days are gone, but still it's going to be a solid dividend payer. Now, Brookfield, we're going to have like a talk about Brookfield. So Brookfield Infrastructure, BIPC at 4.64, but BIP.UN, so if you're looking for the trust unit, at 6%. A lot of investors are asking me, what's the difference between the BIPC and BIP? Well, the corporate class shares will likely drive more demand, so the price will be lower and the yield will be lower as well, but the total return chances are going to be better. If you're just all in for the yield, well, BIPC is a ETF of utilities going from pipelines to data center to railroads, etc. So that could be an interesting play here. CT REIT. So we had Canadian Tire earlier. Now we have the Canadian Tire REIT. So all assets are rented by Canadian Tire, 6.29% yield. But it is a rare REIT that has been increasing its dividend constantly, even during the pandemic. So very, very solid one as well. We got now Enbridge at 6.33%. Does it really need an introduction? Huge oil and gas pipeline, did pretty well over the past 12 months. So if you're looking to add some pipelines to your portfolio, there you go. I have like 3 left in 45 seconds, so doing well. Brookfield Renewable, so pure play on your renewable energy. The BEPC at 5.59, BEP UN at 6.87. Same story than Brookfield Infrastructure. But for Renewable, you have 50% of their assets are hydroelectricity. The rest is wind, solar, and storage. An interesting play. Keep in mind, the Brookfield are quite complex and you need to rely on management, funds from operation calculation. So maybe it's not your type of investment. Keep that in mind. Very complex. Two last one, TELUS at 7.2%. One of my holding as well. This one, definitely still struggling. The numbers are better than Bell. The numbers are better than Rogers. Hopefully, they're going to keep on growing their cash flow in 2025. Now, I'm just looking to see if they're going to increase their dividend or not. If they don't in 2025, it's gone from my portfolio because it's based on my rules. And finally, you have Labrador Iron Ore, LIF. So Labrador Iron Ore, 10%. Dividend, variable dividend. So if the iron ore price goes up, the dividend goes up. If not, it goes down, same as the price. So you're up for a roller coaster, but this company has no debt. It is a streamer, so it makes royalty revenues from those mining companies that are mining the iron ore. So an interesting model. If you're in for the yield, you're going to be happy, but expect a variable dividend, not a stable one. So not always a 10%. All right, Moose. Well, it actually was a little bit more than 20 stocks. I lied to you. So anyways, I hope that you have enjoyed that list. 11 minutes, not too bad, right? So you will have to re-listen to this one to take notes. And again, I do have a super fun webinar next week about cleaning up your portfolio and talking about which kind of stock you should keep and which one you should sell. So if you suffer from paralysis by analysis, this webinar is for you. moosemarkets.com/webinar. moosemarkets.com/webinar. Going to talk to you tomorrow, and we're going to talk about what are the safest income generators at retirement. All right, Moose, that's enough for today. Take good care. We're going to talk again tomorrow, and until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.